So I'm here with Daniel from Prerequisite Capital Management, and we're talking about a subject now that we've talked a lot about over the years, and I've had a lot of questions about. It's gold, and I think everyone knows what gold is, but I don't think everyone properly understands what is the gold market and why does the gold market exist?
Well, the gold market exists because everyone wants gold for jewelry or something, or as a form of currency. So there's two types of currency systems in the world throughout history. You've either got a currency system that ultimately is tethered to something, like gold or like a commodity or seashells or whatever.
Trading system, yeah.
Yep, but the currency is tethered to something is basically the key point, or it's a trust-based system. Now most currency systems in reality in history are actually a combination of the two, but one is backstopped by something and one isn't. And so currently in the world we have a trust-based system, especially post 1971, well and truly, where the tether to the gold standard was completely done away with, finally. Gold is, ultimately a form of currency. When push comes to shove, it's the ultimate form of collateral because it's no one's liability. So most assets today are another person's liability. So like we've talked about with bonds, a bond is a loan issued by some entity, like a government. They need to borrow money, so they issue a bond. And that bond becomes an asset to someone else, to a saver or to someone with a pension or a portfolio that buys the bond. It's an asset to them, but it's someone else's, in that case, the government's liability.
That's right.
Whereas gold is an asset, and if you own it outright, especially physically, there's no one's liability.
Yeah.
It is what it is.
It's your asset.
Yeah, and so in a trust-based world, if ever trust becomes systematically impaired, having gold that is no one's liability, you can own it, you don't have to trust anyone for your claim on it, or for its value or anything. It becomes valuable, so it's no one's liability. It's ultimately a currency, and it looks nice.
So the price of gold is one of those things that people speculate on all the time, and there's many different opinions about that. But what do you believe ultimately drives the price of gold, or what do you see as some of the fundamental drivers of price?
Let's start with what most people think the drivers are, and then we'll unfold to what we think the drivers are. So simplistically, the majority of people would summarize gold as being an inflation hedge. And really, more specifically, what gold really is a hedge against another form of currency devaluation. Right? So gold versus some currency, if that currency, say US dollars or Aussie dollars or Canadian, whatever, if that devalues, then the price of gold is going to go up against that currency. Right, so it's more, and so inflation is more of a currency devaluation dynamic, as opposed, the reason I say this is there's many forms of inflation. So if you lined up 10 even professionals in the room and say define inflation, they'll loosely start talking about a loss of purchasing power or a devaluation of currency in some way, shape or form, but what drives that makes all the difference as to what the implications are, even on a gold price. Right now, and this gets into the more conventional understanding around gold, is that because there's only effectively a fixed quantity of gold in this world that is above the surface. I think depending on where the price is at, it's roughly 7 to 7.5 trillion, or probably 8 trillion now, US dollars worth of gold basically above the surface or as a market cap. Largely, people's view or definition of inflation is when there's too much money chasing too little things. Right, so if more money is created, there's not enough things, that's inflation, oversimplistically. And so most people's view around what drives gold is typically related to some sort of a money supply concept. So if more money is printed, then by definition there's only the same amount of gold out there. So therefore that should, increase the price of gold as basically more money is printed and the supply of money against that is increased.
Right. But that's not necessarily...
Well, yeah, that's not the case because
yeah.
if you line up, but see, it's also hard. How do you define money in this world? Because it's not just your physical cash, and it even goes beyond now your deposits at banks. There's broadening circles of moneyness or money-like instruments that we effectively use in the modern system, in the modern financial system. And so, like a M series definition of money supply, like M1, M2, M3, doesn't even begin to grasp the realities around actual money supply and money-like instruments in this system anyway, right? And the other thing too is that, you know, if you were to create a graph of, say, money supply, however you define it, it's basically money supply goes up like a rocket, you know, from this corner to that corner. Gold doesn't necessarily do that, especially over the last 50, 60 years, and even post-71, there's been a gradual long-term trend for gold to appreciate over time, but there's huge periods where gold goes nowhere or even lower, whereas the money supply just keeps going like that. So there's more dynamics at play than just a simple money supply increase equals gold increase, right? It's just not quite that simple, right? And then even on the currency front, there can be very legitimate and valid reasons for money supply to increase that doesn't necessarily lead to a devaluation of the currency, right? But there's also, especially if it's more government skewed in terms of the creation of money, so more money is created outside of the public sector in private banking systems than is created by the central bank, right? Now, you could argue that the central bank gives license, or the government gives license to the banking entities that then create this money. But there's even mechanisms for money and money-like instruments to be created beyond that anyway. And when you start to get into different types of financial assets and collateralized type dynamics and circulation, then money really gets created from all sorts of areas or effective purchasing power.
Right. So bringing it back to gold, you know, what is the framework that you have for I guess, analysing it and the way in which it interacts with?
At the moment, the US dollar is the reserve currency of the world.
Yes.
And it's used the most, it's rightly or wrongly trusted the most still by private actors around the world. Now that will change in time, but at the moment it's still the reserve currency of the world, and most of global trade is still hyper-dependent upon the US dollar. So the first step is that we need to analyse gold in relation to that US dollar currency system, right? And that includes the broader banking systems and everything else where the supply and demand for US dollars kind of intersects. Now, one of the realizations that people usually don't have is that more US dollars, at least in the last several decades, have been created outside the US than inside the US, right? And so there's this big, what they sort of call the Euro-dollar system, which is kind of more like the internationalized, broader banking system that actually can create US dollars as well.
Wow.
Right? Not within the jurisdiction of, say, the US banking system. So the pool of US dollars effectively, and it's a pretty flexible definition of what is a dollar and what is money like as well, with the way these systems work, is much bigger than people realize. So step number one is what is gold versus the reserve currency? And most people will make a mistake of also analyzing gold in terms of other currencies as well, right? But in doing that, they're conflating too many issues.
Right.
You're going to get, well, we believe that you will probably unnecessarily confuse yourself if all of a sudden your starting point is gold versus pick a currency.
Right.
Because if you separate those steps and you take gold versus the US dollar first and foremost, and then the US dollar versus pick a currency, you get the more purest currency dynamics at play, and you can separate that out from what's going on here, and especially around gold. So gold versus the reserve currency first, reserve currency versus everything else second,
Right.
and then start to think about, well, gold in terms of some other currency as well.
Right.
And
That
if
makes
you,
a lot of sense.
if
yeah.
you conflate that, you start to confuse a lot of different issues, and you're at higher risk of drawing, poorer conclusions about some of the dynamics at play, because they could be more currency system related than. Anyway, but having said that, the best way to understand gold is that it's like on the side of a road we have these flood gauges, right? The poles with the measuring.
Yeah.
So when water's across the road, we can see how high the water level is relative to the road. So that's effectively what gold is. So there's only effectively a fixed amount of gold out there or above the surface. And it's the change in the broader liquidity dynamics of the world, and the US dollar system in particular, that is changing. It's not the price of gold so much as everything else is changing around that.
Right.
Gold is just that measuring stick
Right.
of broader liquidity conditions and trends and issues and all of this sort of thing. And so it's not gold that changes, it's everything else that's changing around that. Now we need to figure out, so you've got the supply of US dollar liquidity globally, not just in the US. US is a huge part, an important part, but also there's a global dynamic and phenomenon going on here. We need to establish, well, what is the situation in terms of supply, in terms of the creation of US dollars. What's the demand for US dollars and US dollar currency, in addition to supply? How are these US dollars being used? Are they being matched with productive output, an increase in useful goods and services and all of this? Or are they not? Are they being created by government instead of the private sector that will tend to, if market mechanisms are in place and we have a degree of contract law that has a bit of integrity, etc., then the creation of these dollars, if it's in that private system, they'll tend to match.
Comes from market growth.
And so the increase in those, that supply is actually a good thing. It doesn't necessarily directly lead to inflation either, right? Because it's sort of matched with that productive activity increasing and increase in productive goods and services, and it's more likely to be a sustainable increase as well. If it's the government creating the liquidity, so they're just by decree, they're just printing more stuff or just conjuring stuff into existence, but it's more detached from an increase in productive goods and services apart from market mechanisms and a just sort of functioning of a system. That tends to be the wrong kind of liquidity.
Right.
So there's a big difference between dollars that are created in the broader, market system versus dollars that are created by the government or by the US central bank in particular. Huge difference from a quality perspective. And that has implications to the gold price as well. Because it's, and so the circulation rate, demand type concepts, all of this stuff factors in. And so we have this situation where the price of gold represents effectively the inverse of either the excess supply or insufficient supply of US dollars relative demand. And so what we tend to describe that as is excess liquidity, right? So across that broader system, if there's more supply being created than there is functional and sustainable demand, that's an excess liquidity condition, right? More supply of US dollars than there is demand for them and productive, sustainable use for them. That tends to appreciate the price of gold.
Right.
If there's an insufficiency, so there's more demand for US dollars, more demand for their use, but there's constrained supply, or even destruction of US dollars, which can happen in debt default cycles or asset impairment cycles and all of this sort of thing, then that tends to be bearish for gold prices. Because effectively, if you think of, so one of the things I say to people which helps illustrate this point is the US dollar can actually become harder than gold.
Yes.
Right?
Yes.
And how does that happen? Well, if that broader pool of US dollars, so to speak, is actually shrinking, there's less, and this is an overly simplistic way of trying to describe it, at risk of that fallacy we talked about before with the money supply. But if the US dollar system is shrinking or hemorrhaging or constrained, it can actually be harder than gold, which is just the same. So if there's less effective dollars, or demand outstripping supply, or supply constrained, or an excess demand situation for whatever reason,
is that because
the
it's
price
the
of gold
reserve
actually
currency?
goes down? Partially. I mean, we talk about the reserve currency because that's really the competitor to gold.
Yeah, that's right.
Gold is a currency.
Yeah.
Now, all of these other currencies, including like the euro or the Chinese currency, or pick one, they're not really even in the same league as the US dollar.
Yeah, that's right.
Not pragmatically speaking, in the world. Now, one day that could all change, but at the moment, the reserve currency, or the primary competitor to gold, is actually
The US dollar.
Yeah. Now, we're just going to leave the whole cryptocurrency story off the table altogether. But yeah, so it's always against the US dollar system first and foremost, because that backstops the bulk of world trade and most of the effective financial system in the world as well. Ultimately traces back to a margin and collateral situation that is predicated in US dollars.
In terms of an asset class, then, that prerequisite capital management, views gold. How do you see it in the mix of your
so
portfolio?
how do we use it in a portfolio?
How do you see it in your portfolio?
Yeah, so it's a hedge against currency debasement. It's a hedge against excess liquidity conditions, which tend to be inflationary on balance. Of those primary factors that we talk about, we need to be able to account for unexpected change in a portfolio.
Yeah.
And so growth increasing is usually an equities allocation, growth decreasing, cash is king. Inflation, depending on the nature of the inflation, but especially if we're talking about excess inflation, like, above any normal bound of inflation, tends to be currency depreciative and gold appreciative.
Yeah.
And so gold is a bit of a hedge to most of those excessive inflation conditions that we would want to protect against.
Yeah.
The hedge against deflation is longer duration government bonds, which tend to do really well in deflationary situations. Yeah. On the currency front, so every investor usually is denominated in one primary currency in which they earn their money, save their money, spend their money, usually, not always, but gold is also an effective hedge against a domestic currency devaluation, or their government going crazy and doing silly things with their currency, or trust eroding, or capital outflows for whatever reason, etc., etc. And so gold plays an invaluable part in all of that.
Yeah, great.
As a counterbalance amidst those conditions, and so
that's really good.
Yeah.
Thank you.